All right. Good morning, everybody. It's pretty red out there, but not exaggerated too much. We got a little bit of a pop going into the close, like a little dead cat bounce before the end of the day. And while we're red this morning, if you look at the US, it's really not that bad, less than 1%. We've got Fed speakers today, but really it's all going to be headlines on the tariff talk. Tonight, we're going to get more information out of Japan. That likely doesn't have too much impact with everything else that's going on. But as always, you want to keep track of that. Potentially, it could turn into something. We're just not expecting it to turn into anything. The trouble right now is this. If we had these conditions a year ago, the S&P would be at 7,000. This is what you would want to see, right? So the idea that we are holding the line and we're not selling off further and it seems like, everything is stable, it's not. With the dollar down like this and the 10-year down like this and the cost of crude, pointing down like that, these are phenomenal conditions. And the fact that we're down with it implies that we can flip and get really fast, right? We're talking like a V-shaped rally to the upside, a reflexive bounce. There's a lot of names for, the forced rally back up, kind of like what we had last Friday. So temper your bearish enthusiasm and be mindful that we could run hard to the upside, and it would not necessarily be bullish to do that, right? We're talking about the idea of a reflexive bounce just putting us back in line. We don't have the AM edition of the Founder's Note yet, so we're still missing a little bit on that side. When I was putting together the levels on Spot Gamma, I highlighted all of the cog lines that were showing. They always have the large levels or additional levels that I put in the picture every day. And I get asked about those cog lines because, well, there's really not a precedent for those, right? It's not an indicator. There's no story behind them. The 11s, 32s, and 92s on the ES or the SPX. So we're at 58.11, 59.11, 57.11, 57.32. It's just the way it is, right? Those are cog lines, center of gravity, and they come up more often than you can imagine. But right now, they also are showing up in the options levels. Or maybe they always show up in the options levels and I just don't catch them because I mainly just look for the volatility trigger, zero gamma, put wall. And speaking of that put wall, we're close to it this morning. Keep in mind, this is where we expect them to monetize their puts, right? That doesn't necessarily mean they're going bullish. You can quit being bearish without being bullish. So just something to keep in mind. We expect to see them monetize here, and we can go through that level and close below it and come in tomorrow and find that the put wall is over our head. We're getting close enough to OPEX that they may not roll it. They may just you know, leave it there until we get closer, and then they take everything and move it for OPEX. What we would like to see is to have that put wall rolled down away from us. That would be considered not necessarily a bullish bias, but it would be a good bias, a healthy thing to see that. This is the picture that I share every day. You see the red boxes, 60.11, 59.11, 58.11, 50.11. That one got my attention. If you look at these every day, you may notice we have levels underneath the put wall, a lot of them, when normally we don't. That means there's a bunch of trades being put on underneath the put wall, and those levels will likely become the new put wall if they do monetize the puts that we have on right now. So one of the things that you can do is you can look for the options at that level. So you got the SPX over here. I didn't carry it across because those weren't cog lines. But if we break 5,800 and we go to the downside today and we're thinking they may roll the put wall down, look at the 5750 strikes and see if the SPX is getting a lot of options piling in at that 5750 because it's one of the combo levels. If we break through that, or if that's not getting a lot of attention, look at 5698. See through that noise right there and just realize that that's 5,700, right? 2 points, one way or the other. But watch those strikes, especially on the idea that, you know, it's the SPX. It has $5 strikes. There is no 56.98 strike. You can trade 56.95 or 5,700. You can't trade 56.98. And then 56.51, read between the lines, it's 56.50. This is generating what we would call an H pattern. I remember Peter Resnicek liked to say that these are, the H stands for hell for shorts, is what he would say. Doesn't have to play out that way. Just keep in mind, this is not considered a bearish pattern. If we forget the leg and we just look at the inverse cup, there's a consideration that this is either a double bottom or an inverse cup. Well, if it's a double bottom, we need to break the previous low and go lower than that into like a 111 or a 1236, trap the bears, and then violently reverse back up the other direction really fast, like a V-shaped recovery. It has to be violent and fast so that we can trap the bears, squeeze them, and their buying adds to the buying, which trips us back up to the upside really fast. If it's an inverse cup, then we would expect it to bounce on the line or bounce on the previous low and form a handle here, a potential handle. So it'd be more like a perfect bounce, a handle, and then the continued move to the downside. Now, this isn't a perfect science, right? Sometimes you can get a double bottom where we bounce on the previous low and that low holds and we run up and we don't go lower. But a typical double bottom will expand lower, like I had already mentioned. And a typical inverse cup and handle will bounce on the line. That's the way it generally works. We bounced and we're making a move up. It's very likely that we're going to try to reciprocate 50% of that right there. If we can't get through that, then that'll be the handle and we'll head to the downside. Otherwise, if the bounce continues, we'll look to run it back to the half, 58.50, and see if we can get through the half back. If we can't get through 58.32 cog line, that'll be our cup and handle. And then we begin the move to the downside and we expand lower. It's interesting to note the call wall is still in the same spot. So we've been challenging the put wall. We've been seeing it move. They're not messing with the call wall at all. But they are adding new levels, which is what that picture showed us, right? They're developing lower structure below, which implies they're willing to run it lower because they'll make money on it rather than trying to develop some support or some structure to flip this around and defend things and try to run it back up. They're positioning to make more money as we continue to fall. I mentioned before 5,800 has been defended multiple times. We can see that if we just go out to the daily. It's not a game of perfect. You don't have to just draw a line at 5,800. You can see when we came down into that 5,800 area, they were willing to buy it back up to defend that level. And it was a hard thing to get through on the way up, right? We fought it multiple times before we got through it, tested it again. So it's very likely if we break that 5,800 and we get below it with some distance, that it will be difficult later on to get back through again, right? We leave footprints behind, we build structure at that level, and then it's going to be something that we have to fight through on our way back up. When we talk about going through it and closing on the other side with some distance, it would help if we put some numbers to it. So if we get below 5,800 or this level, this zone that we're focused on, we need to have a distance of, well, how far would be too far? Now, I picked this low. We could have picked this one back here. 5,700 is a good line in the sand. It may seem like a lot, but considering what's on the table below, like 5,011, that large gamma level in the picture that I showed, 5,011 is underneath this pivot way down here. It's not even showing on my chart. So 100 points down to 57, well, that doesn't seem like very much. So if we get below 5,700, things likely get very nasty very fast. We've got 5761, 5709, and then of course, you can add cog lines to that, 5711, 5732, 5792. But we really don't even want to get below 5,800 to begin with. Cumulative volume is still selling off. It has been since we were running these spinning tops, or when we were in this inside day. We started turning negative in the volume, and it's been headed to the south ever since. We need to see that turn around. This is the cumulative volume index, and it doesn't matter what I have showing above. This one's for the NASDAQ. If you have TradingView, they have one that's better than this, because instead of choosing the NASDAQ, you can choose all markets. So it'll do the Dow Jones, the S&P, the NASDAQ, all of them, which is really nice. So we still have net selling, and that hasn't changed. Like I mentioned yesterday, if we get to one ADR early enough in the day, we can go to the other ADR by the end of the day. Yesterday, we were talking about the move up when we had hit, the lower ADR on the upper edge and how we could flip and go the other way. Well, now it's the other way around. We're at the ADR half, the red line. We can go to the other red line by the end of the day, plus some, really. If this doesn't hold and we begin to sell off, we got 57.92 cog line, and then on down we go. The 21-day average daily range right now is 1.4%. When we think about what a market does on a day-to-day basis, and this one is set for 21 days, it's a market month. What have we done on average on a day-to-day basis for the last month? We've moved about 1.4%. So we have an expectation of, well, what should happen today? We should move about 1.4% because that's the norm. If things start to get out of hand, we'll go beyond 1.4, and then we'll know that today's doing something above and beyond the norm. So far today, we have an MDP that's a missed daily pivot. It's a really wide channel sitting at basically 5,900. The upper edge of the channel, 5,911. We got an 80% chance of hitting that pivot today. This pivot is lower than yesterday's. That's bearish. Price opened underneath the pivot. That is also bearish. And we haven't even managed to get back within the channel yet, let alone hit that pivot. So if we do begin a rally back up off of yesterday's low, the first target is 5,900. It's the floor pivot. We're underneath the weekly pivot. That's also bearish. And we haven't expanded beyond the weekly pivot enough to have any sort of mean reversion yet. So we haven't sold off too far, too fast, and it doesn't owe us any sort of mean reversion back up the other way. Support level 1 is at 57.97. Support level 2 is at 57.20. We've got two distributions so far this week. We left the point of control behind at 59.46. Now we've got a new one at 58.72. And this 58.72 or 58.80 kind of ties in with last week's second distribution. The 2 point of controls are really close too. This is all just trash that we have to work through on our way back up. We are outside the value area, so the expectation is we're going to see that change, or we're going to want to see that change. If they're going to come in and save this market, they'll have to. We would expect them to do it along these lows, and that would shift this profile's value area high and value area low down into this, which could give us a third distribution too. I think we're hitting the 30-week, by the way. No, we cut the 30-week. 10-day, 30-minute volume profile, the TPO finally changed its point of control with the volume profile. We were up here with that point of control, and now it's down here. Unfortunately, we're still underneath it. The hope was that we were going to close from Friday, open into Monday, stay above that level, and then have the point of control move down as we wipe these candles off on the left. Unfortunately, we sold off underneath that level, and now we have the point of control still over our head, just a lot closer to us. That's bearish. If you think about things from the other way around, when we're falling and we've got these levels, we consider them support. We bounce off it, then we fall down to a new level, hit support, bounce off of it, fall down to a new level. Keep that in mind, but flip everything around so that when we fall and then we try to rally and we hit a level of resistance, and then we fall some more and we try to rally and we hit a level of resistance. That's what just happened to us here with this point of control. So it was up here, we fell, we tried to rally, now it's here. If we try to rally, it's right there. We're going to have to fight our way through it, along with all the other levels that we've been talking about. It's not to say that we can't get through those levels, especially if it's news that's giving us the push. Those levels are really going to be important if we don't have news and we're just trying to do it structurally with price without news. It'll be a difficult task, right? A lot of work to get back through those levels. We hit 2 VPOCs yesterday. 58.78, we ran right through it like it wasn't even there. And then 58.29, that's right around the turnaround point from yesterday afternoon. We have a new VPOC, 59.55. And I don't think we have anything else down there. Nope. We can see a little bit of defense this morning around that 58.30 area. A lot of volume, but not matching number of trades, right? If these two profiles looked exactly the same, it would look like we had the one contract, one trade, right? Volume would match the number of trades. But the green is bigger, implying that the number of trades was less, but we had more contracts in each trade, which is why the green has a deeper profile. So what that tells us is there's a lot of big traders down here who didn't put on a lot of trades. They just put on trades with a lot of size. We are outside the weekly expected move. Generally speaking, we close inside the box 70% of the time. The S&P has the most accurate expected move in the entire marketplace, and it generally closes inside the box 8 out of 10 times. Still, when it doesn't, it's a message that the markets either aren't pricing in volatility, or that even with the volatility priced in, markets are making bigger moves than what was anticipated. The week isn't done. We have to close outside at the end of the week. When it comes to running statistics, round numbers make it easier to run models. So instead of counting back every single week that you can see on a 1 year, count back 10 weeks and how many times we closed outside the box in the last 10 weeks. Anything more than 2 means you're at your 70%. Anything more than 3, you're underneath your 70%. Generally, I don't like to use half weeks or short weeks. If it's not a 5-day week, I don't count it. And if you run across anything that looks like this back here, obviously there's something wrong with the indicator that week, right? It was really, really scrunched up. Obviously something was wrong. And that happens. You can see the contract change on that same week. It's just the goofiness of Thinkorswim with its indicators. But you can keep track of the accuracy of the indicator just by counting back 10 weeks and asking, well, how many weeks in the last 10 weeks did we close on Friday outside the box? More than 3 means the market is mispricing volatility, or the markets are more volatile than was even expected. And it's a warning. Keep your position size smaller, maybe take profit in things that are in the green for the longer term accounts, reduce risk. We are 2.7% below the 10-week. And while we've been lower than that before, we can see all this back here in 2022, that bear market that we were in. Since we've come out of that bear market, we haven't really spent much time below 2% on the weekly. We're there now. And we had it back in like August, September 2023 when we had that pretty good size sell-off. You look at the length and the scope of this from, late July to November. It took that long to get that far below the 10-week, and we managed to do it in this short amount of time. On a weekly time frame, we could consider the idea that we're a little oversold, but that should not make you think that it owes us some rally just because we're X distance from the 10-week. The idea is we got here because of headlines. And even if we do flip and run to the upside, like I mentioned earlier this morning, without headlines to fix the headlines we'd already got in this situation, then any run to the upside is likely a dead cat bounce. It'd be the idea that we fall, bounce up some, and then we fall some more. We bounce up some, fall some more. They do that so that it doesn't freak everybody out. Because if we were just to fall, then people won't rotate into, quote, defensive names. They'll just rotate into cash. And when that happens, things get really nasty really fast. $2.7 below the 10-week. That's pretty good. The line should be around 4%. That's where we bottomed out before back here. So we're looking at another 1.25% to the downside before everything starts to hit some extremes and we consider the potential for a stronger bounce and move back up. We also got to consider how they're going to defend it, right? The plunge protection team, they'll start talking about, changes in liquidity, changes in how they will approach liquidity, what they can do with the fund rates. They'll start talking, right? Chipping teeth, making promises, or even just hinting at things like a possible additional rate cut. That's the sort of easing in their standing that can turn this around even in just a short term and get it popping back up. Remember, a lot of this is just sentiment based. At least that's what it started as last week. And that can change really fast. And looking at the 10-day, we're 2.2% below the 10-day. We can get to 3.5, and then we'll start looking for this to get at the short term a potential bounce back in the other direction, like a mean reversion play. It doesn't owe us that from 2.5 or even 2.25, but from 3 it does. If we look at where we were at on that potential double bottom here, we are also coming into a potential double bottom on our distance from 10. Just stop my mouse down there. You can see around 2.25, 2.5. That's where we oftentimes turn back, even just for a short term. We hit the low, bounce back up, come down and hit the low again. Hit the low, bounce up, down again. This whole thing is just a big wave. It's worth noting on this, with these equal lows and this bounce, we were getting lower highs and lower lows that whole time. Not seeing much of a capital rotation. We would expect to see the lower ones green and the upper ones in the red. We still got finance doing good on the week. This is a 5-day change. The idea is money generally doesn't leave the market, right? It just moves to another spot. If it actually starts to leave the market, then all of these will turn red over a 5-day period. And that implies that we're not rotating. They're going into cash or they're going into something other than these sectors. So it could be, we're missing sectors. It could be that they're going into another sector or that they're going into commodities or bonds. They're not doing that too much yet because we're back to flat on this. We're basically back to flat here. Bitcoin Mag 7 growth and value. Software, energy, consumer discretionary, all down more than 0.5%. When the Mag 7 is just sideways, not really participating, we can hold the line and we can get rallies in the other sectors. But if the Mag 7 is just straight up going down, then the market doesn't have much choice other than, at the bare minimum, if it fights it all off, it can maybe stop from selling off hard, but it can't rally at all. So if we want to see this hold the line, we need the Mag 7 to stop falling at the bare minimum. And that includes things like chips, semiconductors, communication services, they got to stop falling and hold the line. And looking at things that are up, precious metals, China, the VIX, and nat gas. China's having their meeting right now, that meeting that we've been waiting for. It's the start of it. It's more than one day. So we'll be looking to see what stimulus they're going to talk about. Whether or not they actually, go through with it, it's a completely different thing. On the precious metals, careful with that if you're looking to play the long, because if they get Zelensky back in and they sign that mineral rights thing, and then the U.S., turns the aid back on, and peace would be bad, or stabilization in the war efforts would be bad for longs in precious metals. So as long as there's still a rift between those two and Zelensky doesn't come to the White House, I think staying neutral or going green in gold and silver precious metals, that's likely. But if they solve that, then those two could sell off. Bitcoin, pot stocks, chips, no surprise here. Everything that airlines not quite down enough. The benchmark is 0.5%, but it's down. It's moving in the right direction for the continued short that we've been talking about in airlines. And financials over the last 5 days, remember, they're still green. So if we do sell off, financials has a lot more room to fall than a lot of those others. Think about the sectors that have room to fall: healthcare and financials. If we do continue to sell off, those two have the most to gain, or the most room to fall. Staples is flat, so it's a good 2% short. Utilities basically flat, another 2% short, and industrials down, let's call it a half. Still get another 1.5. That would bring it more in line with things like building materials down 2, energy down 2, staples down 2, or tech, which is down 4.25. So I wouldn't want to short those sectors. They're already down, plus 2% or minus 2%. If you're looking for shorts, try targeting the ones that are up the most. But I will stress caution on the shorts. Make them short term, or go out long enough to where it can take some time. One or the other. So keep your eye on the headlines today. Watch the dollar and the 10-year. I don't think it's going to help, other than if they find stability, maybe the ES and the NASDAQ will find stability. And that's a really odd thing to say, but it's what we're looking at. So, try to match this dollar with what's going on in the indexes. If we pause here, we could find a pause on the S&P. And keep in mind with the VIX, right? There's VC funds and everything else out there that have to sell, whether they like it or not, when the VIX reaches certain benchmarks like $20, $25, $30. It just activates more selling, whether they want to sell or not. They don't have a choice. course, the same thing works the other way around. Once we start falling consistently and consecutively in the VIX, they'll start buying. It's just VC funds. It's just what they do. And that's just one group. There's a lot of groups out there that have a lot of different rules for the size of their portfolios, the size of their risk. With the VIX above 20, then, you know, things are going to be really hard to rally in the S&P and the NASDAQ. There's just too much forced weight against them. We see the VIX drop below 20, and that changes. Of course, if we get above, say, 25, get into 30, then it's just going to get a lot worse. That will activate a lot more selling in the market. And it shouldn't be, you know, like wild chaos selling. It would be organized, clean, systemic, like we have had, you know, because it hasn't gotten wild and crazy at all yet. That's what I got for you guys. Be careful, be safe, watch the clock, keep your eye on the headlines. I'll see y'all tomorrow.